Hey everybody, Courtney Smith here. Let's get on with our weekly video newsletter here. You've been waiting for it all week. Let's dive right in. But first, let's dive right into this disclaimer. As always, do not trade with money you cannot afford to lose. Come on, get it together here. All right, now let's take a look here. Well, the S&P 500 took off. We talked about this last week. It is occurring on lower volume. So if this is not going to be an explosive bull move, look, I've been saying we should fail up here, and I've been wrong, as we finally did break through. It took us several months. But now sailing is all clear in terms of there's no resistance above the market, but a lot of indicators suggest this is not going to be an explosive bull market. So we'll ride it as far as we can. We're going to enjoy it as much as we can, but we got to be alert that this is not going to be that great of a bull market. Dow, same kind of a picture here. NASDAQ, same kind of a picture here as well. Now, seasonality, look at that. It's like a flat line up there. It's like somebody put it in the hospital and they took it off life support. That is a flat line up there. But what it's telling us from a seasonality perspective is that we're probably in a normal seasonality where the market will probably chop sideways. We're not going to see a lot of explosion to the upside, not going to see a lot of distress to the downside. Seasonal patterns, we now have to start thinking it's not the black line. The black line is 8 years. In a presidential cycle, we should be looking for something that's starting to make new highs here late in July. Well, that would be the top green line. That would be that the Democrats, that Hillary wins the election. That would be the green line up there. That would fit what's happening right now. The blue line underneath that is all presidential election years. So whether Hillary wins or the Donald wins, that one fits our scenario as well. Now, the purple line is actually not so bad either. That's no sitting president running, which is, of course, the case that we have right now. Now, the orange line down there, that's if the Democrats were to lose and the Donald would win. It also is kind of following the scenario, but not quite as well as maybe the top 3 lines. And then the bottom line just does not seem to be working at all. So this is bullish news for us because we got to be looking really, we could look at the top 4 lines, but I'm really kind of trending towards the top 2 lines, which are all presidential election years where we have the most amount of data, or Hillary wins. Those would be the 2 up there. And this is not a political statement. This is a let's look at the seasonality and what does it mean statement. Yield curve, no different story. It's capping our advances. That's why this bull market is so sluggish, is that the yield curve a year ago is coming down. It was very wide last year, so that says we should have a bull market, but it's going to cap things. Now, one of the things that's been happening is that we're seeing the asset allocation move back in favor of stocks. And what this chart is telling us is for really almost a month now, people have been taking money out of the bond market to invest in stocks. And when they do that, we're talking about billions and billions of dollars. You know, those big institutions have a lot of money. Stock market risk indicator, really microscopically bullish. Global shares, dead in the water, don't really want to trade them. Bonds. Okay, now we talked about this one last week in some detail. And actually, the market's following the scenario we laid out last week. The market traded down to the support that comes from several things. First of all, the big gap we left back at the end of June. The old high we left back in June. And I said at that time that we should get down into that area and we should start to rally. I believe that Thursday's price action, that big key reversal day that we did on Thursday with the follow through on Friday, was that rally. Look for bonds to now move higher. That means interest rates moving lower. Bond key factors, still a dog's breakfast. This is a mess. Some are saying higher interest rates, some are saying lower interest rates, and some don't care. So I think we have to say that even if bonds move higher, they're not going to move to new highs anytime soon. And that instead, because of our indicators, it should probably stay around where we're at now. In other words, we'll be bouncing around in a trading range, but we're at the bottom end of the trading range now. The dollar, I told you I've been getting more and more bullish on the dollar, and I think you've got to be focusing here. The dollar continued higher, just as we talked about the breakout of that triangle pennant formation there. The market has it popped out just at the tail end of last week, early this week, set back to the breakout level, and then on Friday, it confirmed this is a legit breakout, and the dollar's going higher. Well, why is it going higher? Well, first of all, it's the U.S. has the strongest economy in the OECD of the major developed countries. Number two, there's been when we sold off down in May, that was really the market saying, "Oh, the Fed's not going to raise any interest rates." But there was a lot of talk in the last couple of weeks from Fed heads to other economists saying that the Fed is going to raise interest rates as early as September. I'm still not convinced that's going to happen. I'm still more in the December, if ever, category, and I sarcastically say I'm not sure they're ever going to raise interest rates in my lifetime. So I'm pretty dovish from that perspective and don't really expect a lot. But the talk on the street was September. Well, if the talk on the street is in September, then that means that the market is more and more looking for interest rates to go up in the United States. And that, of course, attracts a lot of money into the United States because, of the big four economies, big four Western economies, we have the highest interest rates in the U.S. So money is flowing into the U.S. simply to get a higher yield. Gold, on the other hand, you can see we're at a very critical point. A lot of support here at this level. Let's call it 1,300 to 1,310. Let's say 1,310. I'm getting more bearish on gold. I've been quite bullish for quite some time, and we had some long positions. I don't want to be in them anymore. I think that gold's going lower now. And we're going to break that uptrend line. We're going to break it this week. The factors that have affected gold have disappeared. They're gone. If the dollar is going higher, if interest rates are going higher, that's all going to cause gold to go lower. So I'm yanking my bull recommendation, and I'm now starting to look for a bear move. Now, I think that this is a bear move inside of a major bull market. I'm really looking for higher gold prices later. And we are entering into, in August and September, this is seasonally the most bullish period of the year for gold. We've got Indian wedding season come up in October, and that causes the price of gold to go up in August and September. So even though I'm much more bearish than I was even a week ago, we're not going to have a major bear market. The seasonal up move is going to support it. So look for a sluggish downward movement, no real big deal. Let's take a look at our key indicators. For the first time in a long, long time, they are all bearish. All of them are suggesting that gold will move lower. So this confirms my bias. Therefore, this chart is very brilliant. All right, oil also. I think we're in a bear market again. It took me a little while. I thought that maybe this was a flag formation and that we would break out to the upside and get the bull market moving again. But more and more, we're now 6-7 weeks from the highs. Well, bull markets don't really go 7 weeks without making a new high. So I think we're now in a bear move. Having said that, look at the RSI, the green line in the middle of the chart. It didn't make a new low, but the price of oil made a new low. That's called a momentum divergence or an RSI divergence, and it tells me that this week we're going to see higher oil prices. But those higher oil prices may take us from the 44 level we're at now up to around 47. In other words, to the top of the down channel. Not a new bull market, just a little mini bull inside of a intermediate bear. All right, everybody. I hope you enjoyed this. I hope you enjoyed last week where we showed you the whole TradeSmith. You saw what the fully paid up members got. You saw that we're making some really good money in the marketplace. We'd love to have you sign up so you could get that every week. After all, it is a peanut. And if it's only a peanut, you're getting tremendous value. All right, freebies, love having you here. Get your friends to sign up on the podcast. I just looked the other day. We got 5 stars out of 5 stars. We got tremendous reviews. Show that to your friends. They'll appreciate it. And fully paid up members, hang on. We'll come back to you in just a second.